Welcome to week 6 of FABM 2 Analysis and Interpretation of Financial Statement Part 3. Financial statement analysis involves gaining an understanding of an organization's financial situation by reviewing its financial reports. Why do we need to analyze and interpret financial statements? The results can be used to make investment and lending decisions. This review involves identifying the following items for a company's financial statements over a series of reporting periods. Number 1, trends. Create trend lines for key items in the financial statements over multiple time periods to see how the company is performing. Typical trend lines are for revenue, the gross margin, net profits, cash, accounts receivable, and debt. Number 2, proportion analysis. An array of ratios is available for discerning the relationship between the sizes of various accounts in the financial statements. For example, one can calculate a company's quick ratio to estimate its ability to pay its immediate liabilities or its debt to equity ratio to see if it has taken on too much debt. This analysis are frequently between the revenues and expenses listed on the income statement and the assets, liabilities, and equity accounts listed on the balance sheet. Financial statement analysis is an exceptionally powerful tool for a variety of users of financial statements, each having different objectives in learning about the financial circumstances of the entity. The following are the users of financial statement analysis. Number 1, creditors. Anyone who has lent funds to a company is interested in its ability to pay back the debt and so will focus on various cash flow measures. Number 2, investors. Both current and prospective investors examine financial statements to learn about a company's ability to continue issuing dividends or to generate cash flow or to continue growing at its historical rate, depending upon their investment philosophies. Number 3, management. The company controller prepares an ongoing analysis of the company's financial results, particularly in relation to a number of operational metrics that are not seen by outside entities, such as the cost per delivery, cost per distribution channel, profit by product, and so forth. Number 4, regulatory authorities. If a company is publicly held, its financial statements are examined by the Securities and Exchange Commission if the company files in the United States to see if its statements conform to the various accounting standards and the rules of the SEC. Methods of financial statement analysis is the use of many kinds of ratios. Ratios are used to calculate the relative size of one number in relation to another. After a ratio is calculated, you can then compare it to the same ratio calculated for a prior period or that is based on an industry average to see if the company is performing in accordance with expectations.